Graceman Knowledge All, GMK. Welcome to my YouTube channel, where you are taught all you need to know about accounting, finance, and lots more. Remember to like, share, and subscribe.
Welcome to Graceman Knowledge. In this episode and subsequent episode, we are having detailed exposition into the treatment of International Accounting Standard 16, property, plant, and equipment. What is the objective of particular IAS 16? IAS 16 prescribes accounting treatment for property, plant, and equipment with respect to the preparation and presentation of the financial statement. Now, what is property, plant, and equipment? Property, plant, and equipment are items or assets that are held for use in production or supply of goods and services. They are also expected to be used for more than 1 year. Examples of property, plant, and equipment: we have machinery, we have furniture, we have auto vehicle, we have plants, we have land, and we have land and building. How is property, plant, and equipment recognized? The recognition criteria: it is probable that future benefits that is associated to the assets will accrue, will flow into the entity. What is second criteria? Recognition criteria. Second criteria is that the assets or the property, plant, and equipment can be reliably measured or can be measured reliably. What does this mean? If talking about the first recognition criteria, if it is not probable that future economic resources or benefits will flow into the entity, it cannot be recognized as property, plant, and equipment. And also for the measurement, if it cannot be reliably measured, it cannot be measured reliably, it will not be recognized. Now, having talked about the recognition criteria, we go to initial recognition. What are the situations, what are the scenarios that can lead to initial recognition of an asset? The first is an asset can be acquired. What are the costs to be considered when recognizing an asset initially? Knowing fully well that while capitalizing some costs with respect to the acquisition of an asset, some should also be expensed. In detailed exposition to this, we will go more into what part of the cost should be capitalized to make the cost of the asset and what part should be expensed in the profit or loss account. If an asset is not acquired, an entity, due to several reasons, one or two reasons, can decide to construct an asset internally. In such situation, we call it self-constructed asset. Also in this, there will be costs that will be incurred, and part of the cost that will be incurred is important to know the money that will be capitalized to make the cost of the asset, which we recognize in the statement of financial position at initial recognition. Also, when we also have detailed explanation into this in our subsequent episode. Also, if an asset is not acquired, if an asset is not self-constructed, an asset can also be acquired through exchange. What does this mean? I have a motor vehicle, I can exchange it for plant and machinery. Also, this has its own initial recognition. In subsequent episode, we also talk about the accounting treatment of this financial statement of financial position. I talked about the exchange of assets. We also have subsequent expenditure. Yeah, normally, expenditure with respect to servicing, repairs, and maintenance of an asset should be expensed. There are also exemptions to this. And the exemptions to this means that other expenses that are not expensed in the statement of profit and loss and other progressive income should be capitalized to the property, plant, and equipment. Also, if initial recognition is not about subsequent expenditure, we also have separated items. It is possible that an asset can have different separate components with different estimated life. It is important to mention that at initial recognition, it is important and advisable to separate this because each component has different estimated life. To start with, under initial recognition, we start with acquired assets. In this, we'll talk about the cost. We'll establish the cost that should be recognized in capitalizing an asset, or in capitalizing the cost incurred in the acquisition of an asset at initial recognition. Example, on the 5th of August, Gifted Hands Limited, a subsidiary of Graceman Holdings, acquired a machine under the following terms. On the 5th of August, Gifted Hands Limited, a subsidiary of Graceman Holdings, acquired a machine under the following terms. Acquired, that tells us that acquisition, acquired asset. So, what will be the initial recognition? This machine acquisition is under acquired assets. Under the what are the terms? Last price of the machine is 1.5 million. Based on the last price, Gifted Hands is entitled to trade discount of 10% on the last price of 1.5 million. Import duty of 100,000 naira, installation cost of 100,000 naira, delivery expense, delivery fees of 50,000 naira. So, someone will be asking, are we just going to add all these expenses and capitalize them? The answer is no. Why? Because there are exemptions to the costs that will be recognized at initial recognition. Now we go to the first note. Included in the installation cost is 10,000 naira in cost of rectifying an error. It is important to mention at this point that any expense or expenses that is related to wastage or error will not be capitalized but will be expensed in the statement of profit or loss and other comprehensive income. And it is important to note that this is applicable to acquired assets and self-constructed assets. When we get to self-constructed assets, we will explain this further. So, including the installation cost is 10,000 naira in cost of rectifying an error. This simply means that this 10,000 naira will be subtracted from the installation cost of 100,000 naira. That simply means that the cost that will be capitalized with respect to installation cost will be 90,000 naira. Why? Because 10,000 naira was as a result of rectifying an error. Now, give me for the machine, we give a month of purchase and we got settlement discount of 7%. Settlement discount, this is cash discount. And cash discount should not be capitalized. Cash discount will be recognized in the statement of profit or loss and other comprehensive income. And that simply means that 7% of 1.5 million, which is 105,000, will not be recognized. But instead, it will be categorized as other income, statement of profit or loss and other comprehensive income. So, the question is calculating the value at which the plant will be measured at the initial recognition into the financial statement of Gifted and Limited. Now, we'll see out the description. I mentioned earlier that the last price of the machine will be recognized 1.5 million. It was also mentioned that Gifted Hands was paying a trade discount of 10% on the last price. What is the trade discount? 10% of 1.5 million. What is the 1.5 million is 150,000, which will be subtracted because it is a benefit to Gifted Hands. Import duty is also one of the costs that will be capitalized. That's installation cost. Recall that it was mentioned that part of the installation cost is 10,000 naira cost for rectifying an error, and I said earlier that any cost that is due to wastage or error will not be capitalized and hence will be subtracted from the cost of such or the cost at which such is related to installation cost. Of how much? 100,000 naira. And we said that the cost of rectifying an error is what? 10,000. That is subtracted. That means that the cost that recognized there is 90,000. The cost of delivering the machine is 50,000 naira. That means that this man, this is 1.350, 1.450, 1.55, 540, and we have 1.590. That means that in the book, with the statement of financial position of different items, the cost that we recognize is this. It's also important to mention that it is possible that other taxes will be paid as a result of the acquisition of this asset or of this machine. Any cost related to tax will also be recognized. The same way we recognize this import duty and import tax as a result of the acquisition of this asset is the same way we recognize every other tax that is accrued to gifteders as a result of the acquisition of any assets. So, having explained cost treatment with respect to acquisition of assets, it's also important to talk about the recognition with respect to self-constructed assets. I mentioned earlier that an entity can decide to construct an asset internally. This may be due to many reasons. So with respect to self-constructed assets, an entity can decide to do that. And the treatment, the accounting treatment for self-constructed assets is the same as acquired assets. The difference is we know that for self-constructed assets, the purpose of the construction is not for sale. So because it is not for sale, profit element will not be recognized, will not be factored into the cost. Also, we mentioned when we were discussing acquired assets, we said any expenses relating to error or wastage will not also be capitalized, meaning that it will not also form part of the cost of the assets. So let me just show you what I have there. The cost is using the same principle as for an acquired asset. However, an allocation for internal profit should not be included. Any abnormal cost, I mentioned that any abnormal cost, designing error, wastage, or extra dispute should not be included, but should be expensed as they do not form part of the capitalized cost of the self-constructed assets. Now we go to this illustration. Construction of cheap house of grocery room store began 1st of August 2002. Costs related to the construction are as follows. So, cheap house of grocery wants to build their store, and the purchase of land 6 million, architect fees 220,000 naira, purchase of raw material for the construction 1.5 million, employee cost of the laborers and of 4 million naira, production of directly relating to the construction 650,000 naira, state commissioning cost 50,000 naira. Interest on loan to partly finance the construction 150,000 naira. Going to the next, the cover that materials costing 210 naira is destroyed and is waste. That will not be capitalized. Also, 60,000 naira was the gas result of 40 design work. This was not capitalized and will be subtracted from the architect fee. The store took 9 months to construct and was used April 2013. The employee costs are for 12 months to 31st July 2003. So this also means that the employee costs will be prorated to only the 9 months, that only for the period of construction of the grocery store. The production of is an abnormal cost of 65,000 caused by the need to rectify damage caused by site flooding. This 65,000 will also be subtracted from the production overhead, meaning that 650,000 minus 10,000, the balance is what we capitalize at initial calculation. The value the cost of the store to be included in the statement of financial condition upon initial recognition. So what do we do? So we go to the description. We have the description. We have the meeting. Purchase of land, 6 million naira. There is no need to respect to the purchase of land. We also have architect fee, 220,000 naira. There is a note with respect to the architect fee. The note says 60,000 was included as a result of faulty design. 60,000 was employed as a result of we have 20,000 minus 60,000 naira. This will give us 16,000. Purchase of raw material. Is there no to get raw material? Yes. It was discovered that material costing 210,000 had this one and is a waste. So that means that 1.5 million minus 210,000. Also, employee cost of 4 million naira. Employee cost of 4 million naira. We said that the employee cost of 4 million naira are for 12 months, and the construction took only 9 months. So that means that we have 9 over 12 multiplied by 4 million. That means that the cost of recognized will be 3 million naira. Production overhead directly related to the construction. Production overhead cost 650,000 naira. Now, going to the employee cost of 4 million naira, and the 4 million naira is for 12 months, and the construction took only 9 months. That means that the created figure is 9 over 2 times 4 million naira, and that gives 3 million naira. Going to the production overhead. Production overhead costs 650,000, and we're told that the production overhead is an abnormal cost, and we said that any cost that is related to error, fault, or the fine error or damage will not be capitalized. So that means that 650,000 naira minus 65,000 naira will be 585,000 naira. We now go to the interest on loan to partly finance the construction. And Chi House of Grocery took a loan of 10 million naira in order to stop the addition of this. So, and we said that the construction took 9 months. And because the construction took 9 months, the part of the loan that we capitalize will be for the period of construction. The interest on the loan is 150,000. So that means that we have now over 12 times 150,000 naira. Another figure.
125.
So interest on loan now more divided by 2 times the interest of 150,000 will give us 412,500 naira. So what will now be the total cost that will be capitalized at initial calculation? So adding the cost we have of purchase of like 6 million naira, now still for the architect fee, property has accounted for spending by the interest on loan around 11,035,000 naira. So, at initial recognition in the state of financial position, the cost that we recognized for this self-constructed asset, which is the house of grocery, is 11,035,000 naira.
Thank you so much for watching. Do not forget to like, share, and subscribe.